Good morning, ladies and gentlemen. Good to be back on Boutiques on Wednesdays. I really missed you all. And great to have you all joining us this morning for a fantastic session again. We will cover both SA equity and fixed income, or more specifically, credit. Yes, I know some of us get the chills when we hear the word credit, but there are far more to credit that meets the eye, and it can very well be used as a building block in multi-asset portfolios. As for SA equity, so far for the year, it's mainly been a resource rally story. But where are we now? If you were underweight resources or commodities, should you now up exposure, or will you end up chasing your own tail? Maybe there are better alternatives that are better priced. Joining us this morning to unpack SA Credit is Patrick Matidi from Aluwani Capital. And also joining us for SA Equity, none other than Barry Shamley from Investec Investment Management. Barry will also be joined by Ibeth van Heerden to give us a bit of a business update on Investec. Patrick, I believe you up first. You can start sharing your screen if you're ready.
Great. Thank you very much, Eugene. Good morning, everyone. Thanks to the BCI team for the invitation. Always a pleasure to be speaking to you. By way of introduction, my name is Patrick Matidi. I'm head of multi-asset strategies at Aluwani Capital Partners. Today, we are showcasing our high yield fund from two perspectives. One as a standalone portfolio that you can access through the BCI platform, but also, especially for me as a multi-asset portfolio manager, this is an interesting building block for our multi-asset portfolios or our balanced funds, so to speak. But before we go into the detail, let's just do a quick introduction of who Aluwani is. So some of you may have seen us during the circuits with other portfolio managers speaking. But from an entity point of view, we are fast approaching our 10-year anniversary. So we are a young business, having started off in 2015. We are an independent owner-managed an investment business with the founders, the five of us, having started the business about 10 years ago. And our vision largely is to be a multi-strategy business, right? And that's important for us because we do see cycles where if you are a monoline business or a specialist in one area, as and when the cycles come and go, I do not want your business to be subjected to those vagrancies to the point of being unsustainable if one asset class is out of favor for whatever reason. So being multi-strategy is key for us, both from a business point of view in terms of offering, but also from a sustainability point of view when it comes to the entity going forward. Again, just a few highlights. We've got a footprint not only in South Africa, both Joburg and Cape Town, but outside of our borders. And that is also important for us, especially in this product, which is where we are finding a lot of traction, given that those markets outside of South Africa are not as developed and the depth is not quite there. And hence, a credit offering becomes a lot more credible, but most importantly, a lot more impactful in terms of what we are able to offer into those jurisdictions. Our purpose is to be impactful, and I think with a credit fund, you have that ability as opposed to other portfolios where you are bound by either regulation, but also most importantly, through benchmarks where you cannot invest outside of that. But in the credit space, you do have a lot more breadth and spread in terms of what you can do as and when we pursue our purpose. In terms of where this product fits in terms of our AUM, so you can see there is a small sliver, about 3% of our total AUM. But for us, it's an interesting area of growth where we are and we continue to see opportunities going forward. So who is this product, sort of the capability behind it? As I said, I'm more on the multi-asset side. So I look at this offering from a building block point of view, but the actual portfolio itself is co-managed by Monica with the assistance of Conrad, who hopefully is not a stranger to yourself. The capability has been around since 2010. So this predates Aluwani in that we have been working together before then. The targeted return is that 3. And on the BCI platform, we've been around since 2022, where, as I shared earlier, we've got about just shy of 3 billion of assets under management. And then the people behind the product on a day-to-day basis, as I've mentioned, you've got Monica, who's the point person. But what we've done, which is quite interesting for us, is we've created a co-head structure for the credit offering. If you look at the right-hand side, we've got two building blocks, listed and unlisted. This is where the high yield fund tends to play, and that is run by Monica. And then more towards sort of the higher end of the risk spectrum, we've got private debt and alternatives. This is where we are finding a lot of interest, especially in our SADC jurisdictions, and that effort is spearheaded by Sabelo. The team supports all capabilities, so from a credit point of view. So the process in terms of how we look at credit, and then also how we look at instruments and valuation is supported by the team that you see on the screen. And interesting, today we've got a new member who's joining us. So hopefully when you see this slide going forward, there should be one other face. Again, an indication of what we are seeing from a growth point of view, both in terms of investor interest, but also opportunities on the ground. And then just to give you a sense of where it fits in from a risk-reward spectrum within the credit offering. So as I said, Monica looks after the high yield fund, which is sort of the middle or the moderate risk in the spectrum. And then we also have another fund on the BCI platform, the Income Plus Fund, which is a little bit lower in terms of risk and reward. And then more on the upper end, the SME and the private funding style. This is where Sabelo and the team sort of operate. And then very briefly, in terms of the mandate, without going to all the detail, just look at the the source of return. I think for us, this is important because it's very, very different. It's very diverse. And also in a multi-asset portfolio, it brings something slightly different as opposed to your traditional asset classes. And I'll share with you what we mean by that in the next few slides to come. And then the specifications in terms of what we can or can't do. I think what we need to focus on, which again is an area of interest and very and diversification, is around offshore. So yes, the fund can go up to 25% offshore, but also we do play quite aggressively. Well, not aggressively, but quite interestingly and tactically on the continent. So we do see a lot of African sovereigns who are able to borrow money in offshore markets, in dollar-based currencies. We are able to participate and actually get a decent yield of those assets. Clearly, we do hedge the currencies, so we do not take any local currencies of those sovereigns. But interestingly, over the last couple of years, we have seen quite a few countries go offshore and then hedge. And in a lot of those instances, clearly there is an IMF backstop, which also makes it a lot more palatable from a risk-reward point of view. And then who's the fund aimed at? I guess by its very nature, it's aimed at investors or income investors who are looking for a CPI plus, sort of a yield pickup that should come with low volatility. And obviously, in the credit space, the important thing is to make sure that you get your money back. So capital preservation is key in terms of what we try and do and offer in this space. And then secondly, for us in the multi-asset space, as I said, it is a nice building block that we can add. And for us, it actually makes life a lot more interesting in that you are able to push out your investable frontier where you are able to add a lot more return, having taken a little less volatility and risk, which makes the entire offering from multi-asset portfolio point of view a lot more interesting. Then the process itself, as run by the team, it is a fairly typical investment process. So we do worry a lot about the macros and the sectors that we can invest in, because we do not, ultimately these businesses that we invest in, are subjected to the daily grind of the investment horizon that we're looking at. So macros are important, and I'll share within the next couple of slides in terms of how the portfolio is structured, given some of these parameters. We spend a lot of time on the bottom up. So here we look at the various instruments that come through in terms of credit. We look at the company itself. We look at the balance sheet quality. Is the balance sheet showing signs of stress, or is the capacity to can take more debt? We look obviously at the cash flows in terms of ability to can repay us. We look at flexibility. Do they have other funding options? Should things come to a head? Deal structuring is very, very key in this space, in that you need to make sure that you contract properly, especially if things do go wrong. And we have seen a few things go wrong in this space. So in the unlisted space, where you have the ability to can sit across the table and actually structure a deal with the lending company itself, it becomes a lot more interesting because there you have the ability to actually dictate terms and set through terms and conditions that hopefully are acceptable to both parties. In the more sort of a matured side of the credit space, especially the highly rated stuff, unfortunately, that ability to be flexible on a structuring basis can be fairly constrained because you are dealing with a fairly cookie cut type of approach where you either take it or leave it, and if you don't, someone else will take it because the deals come already sort of a fully baked from a structuring point of view. Rating, we do a lot of our rating ourselves in terms of credit quality. We do also use other, third-party bespoke systems that are available out there. And for us, credit rating is key because it gives us a sense of, the quality of the business, but also it informs the pricing or the risk that we're willing to take, given the quality that we're seeing from a rating point of view. And then also quite importantly, and a big part of our process is around ESG. So here we focus on non-financial aspects of the credit paper that comes through that can make or break the actual numbers that we are seeing, especially from a pricing point of view, right? So here we spend a lot of time on assessing leadership. So is this a team that has got a good track record of value creation for stakeholders? We look at oversight, so we look at governance. A lot of times when things go wrong, you tend to find that the governance side has actually been lacking. So we do spend quite a lot of time on the governance side, looking at the board, the composition, the balance between non-execs and executives, and those kind of things. And then track record also in terms of just how the company has behaved in the debt capital markets over the last while. Things like transparency is key. In this space, you don't want to have to wait for financials to come out, 3 or 6 months after year end. You want management team to actually pick up the phone and call you if things are not going well, so that you know upfront what's happening, so that hopefully you can be a lot more flexible and maybe in some instances actually jump in and assist the business, before it actually goes into a lot more strain and therefore putting your capital at risk. And then obviously all of those pillars lead into an investment decision in terms of whether to buy or not to buy. Over and above the detail that I've shared in the previous slide, we also do focus quite a bit on the investment clock. So this is an indication for us as to where we think we are in the credit cycle. So typically you want to be sort of a bottom left to sort of going up to the right, which is where we think we are, which is typically the sweet spot where rates are coming off. Spreads are still there and exciting, but clearly, as and when the economy starts to overheat in the form of GDP being sort of towards the peak, followed by interest rate hikes, you then want to start to reduce your risk appetite, and hopefully the spreads by then are starting to compress. But for us, we still think that there's still a bit more to be had, from a risk appetite and a spreads point of view. I think asset origination is key. So in the traditional debt capital markets, as I said, the banks come through, it's a well-regulated, well-matured sort of a market. But in the private credit space, which is where we tend to play, and this is where, let's say, the lower-rated space, you do find a lot more opportunities, especially on a bilateral basis, where you can sit across the table and negotiate with the company in terms of the lending profile. I'll skip on this slide. I think it's self-explanatory, other than to say that the source of value are very different. So we started with investment grade all the way through. I think the more important one is this following slide here that gives you our framework from a risk point of view. So it gives you the risk budget in terms of the different credit ratings that we are able to invest in. So you can see, if you look at the different instruments that are available and the different risk budget, for us it's aimed at ensuring that we maximize the information ratio, right? So we make sure that for every amount of return that we're giving, we are taking as little risk as possible. And this framework also helps us to make sure that we stay within our guardrails and not veer off in terms of our risk appetite. And then where are we currently from an exposure point of view? So again, just gives you a sense of the portfolio currently. If you look at the table on the right-hand side, it gives you the different risk and a sort of a quality spectrum from the highest rated, which is the sovereign, all the way through to the single B, which is where we draw the line. We do not go beyond that. So you can see currently about 15% of the fund is in highly rated and government guaranteed stuff, and then about 0.6% is sort of towards the lower end. And the more exciting part for us is the middle bunch, where sort of between triple B and B, where we are seeing a lot of excitement. And again, from a risk reward point of view, we are seeing the rewards actually coming through. And then on the left-hand side, just gives you a sense, again, in terms of the breakdown from an instrument and a portfolio construction point of view or clustering point of view, where the top 10 instruments about 60% of the portfolio, and then about the top 30, about 90%. So a nice spread of assets, nice diversification, and all aimed at ensuring that we give as much return as possible without pushing out our risk parameters. And then lastly, from a performance point of view, you can see that it's actually done what it's supposed to do in terms of being neck and neck with Steffi. And then, as I said earlier, in terms of the efficient frontier, from a multi-asset point of view, you can see once you introduce credit into a multi-asset portfolio with traditional asset classes, you then have the ability to can push out, your investment frontier and get a lot more, a return. If you look at the sort of the bottom left, with not having to take a lot of risk, to actually enhance the look and feel of your multi-asset portfolio. Then lastly, in terms of conclusion, we think for us, this asset class, it has the potential to offer a lot more with a lot less volatility, a lot more than your traditional asset classes, not only in the fixed income space, but also across the board from a multi-asset point of view. We think we're a decent team that is well right size for the opportunity at hand. And then lastly, we think that we are still in the sweet spot where we are continuing to see a lot more opportunities in the space, despite us being in the right side of the cycle from a GDP growth point of view. So Tim, I think I'll leave it there in the interest of time, and then back to you, Eugene. Thank you.
Patrick, thank you so much for that. There is some questions coming in from the audience, but I'm going to park that there. And then we've got Edith and Barry from Investec. Edith, I'll hand over to you.
Thank you so much, Eugene. Thank you for having us, and thank you everyone for your time this morning. My name is Edith van Heerden, and I'm part of the distribution team at Investec Investment Management, and it's my privilege to give you a brief introduction to our business. And the simplest way to do that is to tell you who we are not. We are not 91, okay? Investec Investment Management is the original investment capability. We were founded for the purpose of creating investment solution for our private clients' wealth management arm. And today we are a business that manage assets just north of 300 billion across 25 different unit trust funds. And the management of those portfolios are informed by the deep experience and knowledge of our global investment strategy group sitting across South Africa, the United Kingdom, and Switzerland. However, I want to highlight this for you. It's important to remember, specifically in the light of the conversation that we have today, that our investment process defining value rests in our heritage, sitting across private clients like many of you on this call. We have built a legacy of understanding the deep need of clients' emotional resilience to stay the course in order to be successful in their wealth creation journey. The mandate we're going to be discussing today, the Investec BCI Dynamic Equity Fund, often tests that for clients. It's a mandate invested specifically and exclusively in South African listed equities. It's a high conviction portfolio, style agnostic, and contrarian in its approach. We appreciate that being contrarian is often very uncomfortable. If it wasn't, we wouldn't be rewarded for our returns in the long run. And for our existing investors on this call, we want to extend to you a nod of deep respect and humble appreciation that you stayed the course with us. To be successful in this kind of strategy, as we have been, requires deep discipline, rational thinking, a commitment to our clients' outcomes, and ultimately emotional resilience. Something that we have shown in our track record over 15 years, and more recently have felt the test along with you. I want to assure you that our positioning today remains contrarian, and we believe that this is what will reward us in the future. But you don't have to take my word for that. Here to tell you more about the good, dare I say great, bad, and ugly that we've seen in recent history is Barry Shamney, co-portfolio manager of the fund, along with Peter Vogel, and also a member of our investment team. I'm now going to hand you over to Barry. Thank you.
Thanks, Edith. And good morning, everybody. Thank you for joining us this morning. I know our portfolio manager, Clive Stodisjake, just did a roadshow with the good, the bad, and the ugly. So we thought we'd continue that theme, such a useful theme. We're going to start off with the ugly, and that's just the short-term performance of our fund. We do have some good news. The fund actually did have a pretty good September, so I think that number now, well, specifically for the B class, will be closer to 10% for the year. So it's not that bad, but our long-term track record's still intact. And then I just wanted to unpack a little bit of this performance or this underperformance year to date. If you have a look here, what we've done is broken it down to sort of three key factors that impacted our performance over the year. A precious metals underweight, which that underweight cost us just under 10%. And I think I was thinking about this ahead of the meeting. I think the funds that are more benchmark cognizant, it was so I guess it was easier for them to have that precious metal weight at the start of the year. To have that sort of level of precious metal exposure in a non-benchmark cognizant fund takes quite a high risk appetite. So while we have had some gold and platinum exposure, we certainly haven't had to the extent that what the benchmark desires. Similarly, to an extent, the exposure to NASPAS and process. While we have had precious metals and both NASPAS and process in our portfolio, they've been position weighted from a sort of a risk management perspective. So we may have had between 6 and 8% in a NASPAS process, and probably around 8-9% in our gold positioning year to date. But nevertheless, it would have been nice to have more. But I think it's always important to remember this fund through time probably averages around a third large, a third mid, and a third small cap. And it was unlikely that we were going to have such large exposures to those top performing shares in those categories. We did have some unfortunate developments in some of our underlying companies. Just in terms of performance, we find them all still very attractive. Montauk, HCI, and Afrimat. Afrimat, unfortunately, I mean, our thesis on that was that the acquisition of Lafarge was going to go according to plan. Unfortunately, there were delays in the competition approval of the business. It led to delays in the turnaround, which has created a bit of a lag. Nevertheless, we still back management. We think they're highly respected capital allocators, Andries van Heerden and the team, and we have actually been accumulating slightly more. HCR, the discount there has widened substantially, and from the same house, I guess, Montauk. And as a result of that, it has actually attracted activist investors who are now working to try and reduce that discount. So you're getting in HCR specifically a discount of close to 60% with some assets inside that are very depressed. So one that we will probably be adding to slightly over time. So the market close to 30% over the period, a lot of that being driven by those precious metals, NASPAS process, and to a smaller extent, MTN and BTI. So as I've just said, in terms of our portfolio, we've got sort of a third across large, mid, small cap average through time. And if you have a look at the factor weights of the JSE market buckets, if you look at what area of the market is most exposed from an interest rate play point of view, it's that small cap sector where we do have some reasonable exposure. So that was the ugly, but less ugly over the last month, and a nice improvement. Moving on to the bad, I think we've just missed another amazing opportunity to assist the SA economy. We've had inflation coming well into range. We've had the US talking about and market pricing in more cuts in the US, and yet our governor stood pat. I think it was a 3-2 vote again, and really this is not helping us. We have amongst the highest real rates in the world, and it's something that I think would go a long way to improving consumption and improving consumer confidence in the SA economy. And then moving on to the good, an amazing performance by Sasha in the last test. I think a new record for highest points scored in the test, and the box coming back from a shaky start against Australia and doing us proud once again. And I think that's, I remember that feeling when we, in the second half of that test against Australia, how disappointed and despondent South Africans became. And then from the depths of despair, we rose again. And I think that's a little bit like our market. I think we always face these problems, but we need to see these problems as opportunities. And there are a number of companies in our market that do act in that way and positively reframe these problems and find the opportunities. And because it is a risky market to operate in, and because there are opportunities, our median ROE for stocks is 18%, which is well ahead of developed market peers. So you really are being rewarded for investing here. So when you start your process with looking at things from a positive perspective and you see the potential for opportunity here, you can get quite excited. I mean, we've got this perception about unemployment. Yes, it is high, but we know it's not as high as what is officially recorded because of the informal economy. Same goes for the GDP numbers. And there's a lot of opportunity in this township economy or informal economy. And that definitely came across as a theme at the recent RMB Small Mid Cap Conference. Africa and the informal economy were definitely areas of growth and opportunity for a lot of the companies there. And then lastly, and importantly, reform momentum has surged, and I'll show an example of that later. So this is the ROE I was talking about, that's South Africa in the sort of mustard color. But it's not only that it's you're getting a high ROE here, it's because you're getting that at a very attractive value. If you look at this chart on the right, you can see the median price to book. We stand out. We're exactly where you want to be. High ROE and a low price to book. And that may be because of the assumed risk here, because, I mean, everyone is always very cynical and very pessimistic about the outlook, but yet we always manage to survive and thrive. The other good news on the SA economy is the SA Commodity Export Index. I think it's important to highlight that the precious metals are a big and growing portion of this. I think it's close to 40% now. And this is certainly going to help. If you go back to around 2021, you saw how that positive move in the PGM basket and the other commodities, how positive that was for fiscal revenue, how positive it was from a trickle-down effect into consumer confidence, and how much it impacted our smaller companies that benefited from that trickle-down effect. It assists our trade balance. And here you can also see most recently in the, I guess, the maroon color here, our tax income has been surging. I mean, look at that number in July there versus previous years. And that further VAT increase may not be necessary at all. So some really good news on that front. The other thing that surprises us, and like I said, we are positioned with a lot of exposure to mid and small cap, and those are very sensitive to the SA sort of SA interest rate. And we've seen the bond index climb by over 10% this year to date. And yes, these interest rate plays they're actually slightly down. I mean, if you have to look at our discretionary retailers, you're probably looking at something like 20% down across the board. The banks, if you had to strip out the dividends, they're probably flat. So it's been a very, very tough year for SA Inc. It's been almost everything non-SA Inc. that has driven the market. And that's amazing. Like I said, when you look at the ALBI, when you look at how much the rand has strengthened over the year, you would think that we would do a lot better. But like I said, when we saw that commodity price basket move in 2021, those SA Inc. Shares did follow. So part of the problem may be the higher starting valuation of these SA Inc. shares at the start of the year, but a lot of them have derated now substantially. Another positive that nobody talks about is the year-on-year growth in residential house prices. Not just the Western Cape, but the national numbers are increasing as well. And that will certainly help boost consumer confidence. And then just in terms of reforms, we'll get on to the BLSA reform tracker just now, but we've got that national transmission company that's going to be established. We've had those 11 rail slots opened up. So that's going to be very good. That's going to help us get a lot of iron ore and a lot of coal out of the mines into the ports. I've spoken a little bit about that informal economy that's not really being measured properly. Gigi Alcock, who's a wonderful speaker, spoken about a R1 trillion economy there. We had recently Harry Fourie talking about how he actually thinks, based on the transactions they see as a bank, as Capitec, that the unemployment rate is probably closer to 10%. And then lastly, I think a lot of people don't talk about this, but we potentially are going into a period of very strong tailwinds for emerging markets. We've had a 10% dollar weakness this year. It's very hard to say for sure what currency is going to do, but we have had, this is potentially the start of a long-term structural trend. We've had a more than a decade of dollar strength, and we could well be on the way for a period where we have dollar weakness, which will be unbelievably positive for emerging markets and particularly commodity exporters. And then lastly, this is a reform tracker created by BLSA and Kratom, and they're measuring 240 deliverables across economic governance, criminal justice, and we see this massive surge in the last quarter. 26 of the deliverables have been marked as complete. I think there are just 8 left, well, not just 8 left, there are 8 that face severe obstacles, but the bulk of them are in progress. So I think it's great for transparency and accountability that people are monitoring this, and hopefully this will also lead to some improved confidence in the economy as we go along. So it's been a tough year for SA Inc. It's been a good year to be a sort of benchmark cognizant fund, but we always think that you sort of sow the seeds in the tough times. We're finding more and more opportunities in the SA small and mid-cap space. There's a lot of underappreciated growth there. We're selective. We do have exposure to gold and platinum through Pan-African Resources, which has been a top contributor, not for us just this year, but probably over the last 10 years. And platinum, we took in an opportunity through the unbundling recently of Anglo America's stake of Valterra. We do have some rand hedge. We've got diversified miners, Anglo American, and some banks and insurers. Where we're cautious or we don't have any exposure at the moment is to the telcos and energy. Maybe that's 10% of the market, but the opportunity set just doesn't look that exciting to us at this point. Not to say Sasol can't go up. I think it's a tactical trade, but I think it's very hard to have a long-term positive view on that company. And that is it. I think we've been through a tough year, but we believe we're well positioned, and we are hoping for better days ahead. We're comfortable with the valuation and the outlook for a lot of the companies that we're invested in. And that's it. Thank you.
Barry, thank you very much for a very clear presentation or positioning of your fund and where you are. I'm going to start with a question from the audience. I mean, it's top of mind for, I think, a lot of investors at the moment, and it's a bit of a FOMO story on gold. Your position on gold at the moment, I mean, gold is at all-time highs. And the question from the audience, is this a time to invest more or less in gold? Do you take profits, or do you keep going?
It's a difficult one. I mean, if you look purely from a technical point of view right now, it is very overbought. But if you look from a fundamental point of view, I'd say there is still juice in the tank for it to go higher over the longer term. I think what got it to these levels hasn't changed. The fact that the US is in an untenable fiscal situation, the fact that other central banks are buying it. You've got, I think, Chinese insurers that are going to buy it as 5% of their float now. They were asked to consider it. So I think there are still long-term structural tailwinds for gold, but I would say in the short term, just from a tactical opportunity, it feels like it's run too far ahead in the very short term. 4,000 may just offer some sort of resistance in the short term, but you never know. With the geopolitics, anything can happen, and it could break through there on a sort of a negative development on the geopolitical side.
If I look at the price levels, I tend to get a little bit nervous, but I mean, some people still call for gold prices going to 5,000, but time will tell. Just going back to your positioning, you did show and mentioned, the healthy exposure to SA small mid caps or SA Inc. Do we need a catalyst in SA for those shares to actually re-rate? Do we need to see more rate cuts before we're really going to see a re-rating and some profits coming through?
I think a rate cut will help, but I think similar to what we experienced in 2021, what may cause it is you might start seeing some rotation out of the gold. So I think a lot of funds have done very well, being long Naspers, long gold. You may start seeing some rotation because you've had a meaningful derating a lot of these SA Inc. shares. An example is maybe a Mr. Price, which I think started the year on an 18. It's probably derated to a 14. And the earnings base is now normalized. I think we rate cuts will go a long way. I don't know if that will necessarily be the catalyst. I think what the catalyst for me will be is just these smaller companies starting to show some earnings growth. So you've got the very attractive valuations like a KL Group, I think is like on a 6 multiple now, maybe a 5% dividend yield. If they come out with a decent earnings growth, I think that'll get the market interested. So it's just, I think it's the growth aspect more than the rate aspect, just delivering on the growth. I think they all went through a soft patch at the start of this year. I think confidence was hit on the consumer side because of the ramblings over the GNU with the budget. I think because Trump targeted us specifically, but I feel like through the middle of the year, confidence is starting to build. We're starting to see people buying cars again. You can see in the Motors results. So I think optimism is starting to build again, and I think we'll start seeing it sort of trickling down into these companies.
You mentioned the tailwinds for emerging markets with the dollar remaining under pressure. But we've seen it in the past as well, more than a decade ago when, the US, it's actually longer, it's about 13, 14 years ago, when the dollar is under pressure, US is under pressure, emerging markets tend to do well, except SA. We we almost seem like, we keep on scoring our own tries, and when other emerging markets thrive, SA remains in the doldrums. So on the ground, and it speaks to one of the comments from the audience as well, on the ground, it doesn't feel that well. Yes, tax collections is up, and we don't need the VAT increases, and that's all I think a lot of it's on the back of terms of trade that's doing extremely well. But we've got sluggish growth, and we've got high debt levels. How does that impact on SA Inc. stocks?
Like I said, I think the growth may be sort of underestimated. I do think I think it's tough on the ground, but I do think with those reforms, I think things will start to open up. I think with the rail improving, with those rail slots improving, we'll start getting the iron ore out the country. It's interesting. It's the equity market that's been struggling, but if you look at our currency versus other EMs year to date, we've actually been better than the other currency. So I almost feel like sometimes it's ourselves, it's our own sentiment that holds us back. Like we're just perpetually cynical and expecting the worst. We hope for the best, but expect the worst, and almost sort of trade our businesses for the worst. Nobody is like sort of willing, and that's why there's such high moats, because nobody's actually willing to commit capital. So the incumbents there do really well because nobody comes to compete with them. But I think that's the point, is if you can find those incumbents that are listed on the JSE that are going to benefit with a bit of top line growth, then you can do quite nicely. But I think that's why that reform track is so vital. If we can hold the government to account and we can see that progress, hopefully it'll build that confidence and get the SA consumer moving.
Tend to agree with you. There are definitely shimmers of light out there, and things are definitely improving. And I see some comments coming in from the audience. It all depends on what you want to listen to and what you want to read. If you look for the good, you will find the good, and there's still a lot of good in SA. Barry, I want to step off equity for briefly. Patrick, if we can maybe step onto your high-yield fund, maybe just to better understand the fund. One of the questions from the audience as well is, what is the correlation of the high yield fund relative to the Albi?
Yeah, it's an interesting one. So in the fixed income sort of complex, the correlation is a bit high. I think the last I checked about 0.5 or so. But then in a multi-asset sort of a context, it becomes very low. Right, so enhance the benefit of having the strategy in a multi-asset portfolio. If you look at the product itself, the high yield fund, as I showed you in one of the slides, we do invest in government bonds. We do invest in some of the listed credit. So there you do find that correlation actually coming through. But it's as and when you come down sort of at the credit spectrum, then you get the benefits of diversification through low correlation. But also we don't want to go beyond there, because then you start encountering other issues from a risk profile point of view.
Yeah, and it's exactly that. My understanding of a fund, it's a highly liquid fund, playing on the shorter end of the curve, and again, less sensitive to rate movements or movements in bond yields, hence the lower levels of volatility. So definitely for clients that are, looking for a lower risk type of solution, maybe it's alternative to cash and beating cash type of returns. Just in terms of your current exposure, because you do have healthy exposure to credit, we're focusing on credit. But if I look at things like bank rates at the moment or bank credit, I mean, some of the banks are trading below Albi. So the credit spreads at the moment, is very thin. And the recent roadshows, we've heard a couple of comments from some other fixed income managers on, the positive outlook on bonds and how our longer dated govies can still give clients attractive returns. How do you position the fund relative to bonds? Because we know investors are greedy. They want maximum upside.
No, absolutely. Yeah.
But relative to SA bonds, how would you position the fund, and why then include the fund?
So I think, as I showed on one of the slides, the fund can go 100% in government bonds, but clearly we do have a duration limit, so we can't go ultra long. I think if I recall, we limited about I think 5 years or so. So we tend to play in the shorter end of the Albi. Right. So then when you start to compare, the real yields on the upper end, on the longer end of the Albi, then it's not fairly comparison, because you can't play there, from a fund structure point of view. But if you look at banks, which is where we do play, yes, you are right. Bank spreads have compressed quite a lot, especially during COVID, where there was this massive flight to quality, where I guess the market felt a bit more comfortable in that space given the uncertainty. And then those spreads have held throughout, right, in terms of compression. We are there selectively in terms of the names, but also from a duration and a maturity point of view. As I said, for us, the sweet spot is more on what we call the unlisted space. Right, so here you do still have credit quality on your side, but it's more credit that you source, on a bilateral basis. So these are guys you sit across the table and negotiate with. You find, a common sort of a footing in terms of pricing, and from a contracting point of view, you can then put in your T's and C's, which can then brace the portfolio from a risk point of view. So this is where we are finding a lot of excitement still. So it's not, the area where you still have a lot of band fights in terms of assets coming through and therefore yields compressing, but it's more assets that you can originate on a one-on-one basis, which is, I think, for us a bit of a yeah, I would say, a competitive advantage, because being one of the larger fixed income houses, people do tend to come to you, right, as opposed to through a traditional distribution models.
Patrick, you did show one of the slides where you showed the exposure of the different kinds of credit that you've got and the ratings of the credit. You also briefly alluded to a couple of mines that went off in the past 4 years. I think we all know about it in the credit space. And in my opening statement, I also said, if people hear credit, they get the chills because they think about things like that. So risk mitigation in a mandate like this is key. I think maybe just unpack that briefly for the audience, because Aluwani missed, I think, all those mines in the past. What makes you so exceptional with managing risk in the portfolio?
So it's a combination of things, Eugene. It's one, the top-down view we take, on the sectors. So there are some sectors that we don't want to play in just because of the inherent risk therein. Also, we do not always back ourselves, to be all things to all people, and therefore have a wide spread in terms of depth of knowledge. So that's the first thing in terms of picking, where we want to play from a sector point of view. And then once we have that framework in mind, then in terms of the assets that we look for, as I showed in the previous slide, we spend a lot of time looking at both the quantitative side of the business, so the balance sheet, the income statement, the ability of this business to actually support the debt that is sitting on the balance sheet and more, and obviously the income statement in terms of affordability and repayment of that credit going forward. And then also we spend quite a lot of time with management, right? So ultimately in any investment decision, you are backing the team to can actually deliver on the strategy. So we need to understand this management team, their track record, the extent to which they've been able to, generate value for stakeholders and then pay on time and all those good things. And as I said earlier, also governance is key, right? So to the extent that, you've got a fairly credible board in place, well balanced in terms of independence. That for us is also a thing that we watch. As I said, also, if you look at some of the bonds that have gone through, right? Yes, you can look at the numbers, you can look at the income statement, but ultimately, if you do not have a proper governance structure in place, if you do not have a credible management that is, behind the wheel, you tend to find that tends to be the red flags that we've missed. And so us spending a lot of time there, hopefully that gives us some chance of avoiding some of the pitfalls that we've seen. And then when it comes to portfolio construction, we want to ensure that the portfolio is well diversified, right, in terms of exposures, in terms of names, in terms of sectors, but also with different levers, right? So we do not want to put all our eggs in one basket into one particular credit rating or one particular maturity bucket, but try and spread so that if one or two do go wrong, hopefully you still have enough, that can carry through. And then quality also matters. So yes, in some instances, we look at banks, the spreads have compressed, but you also want some element of quality in your portfolio that can actually keep you going, especially when things do actually become unstuck in other buckets within your exposures.
Definitely a steady Eddie portfolio, for lack of better words. When you just look at the Morningstar numbers, you are able to deliver, well above Steffi. And if you just look at the line graphs, there's far less squigglies. So definitely suitable for clients looking for high levels of liquidity, doing better than money market, but with far less volatility. So I do think there's a place in client portfolios. And even thinking about things like living annuities, because I know sometimes people use, or investors use, a specific fund for income drawdowns, but they want, again, returns above money market, but without the volatility, possibly a good use for the fund as well. Patrick, I'm going to step off fixed income. Barry, I want to come back to you with two questions from the audience. The one is on HCI. What could the catalyst be for HCI going forward? And what if Total walks away from Namibia?
Okay, so sometimes you have to make your own catalyst. So we were one of the parties that voted against the remuneration, and we do take up the opportunity to engage with the company. And what we are proposing is for them to change their remuneration where one of the KPIs will be reducing that discount to NAV. So like I said, a lot of the underlying assets are cheap, but there's that substantial discount. Part of that discount may well be attributable to the probability of Total walking away from that Venus discovery. There's nothing more that the company knows or that the market knows at this point about whether that deal will go through or not. But I think just from a common sense approach, my feeling is that Namibia are very dependent on their economic growth on this project. It doesn't suit them for Total to walk away at this part. So I think there's a bit of sort of, they call it horse trading. I think there's some negotiating going on. I think there's a specific requirement around the project which reduces the IRR slightly for Total, and I think they're trying to negotiate with the Namibian government to have that removed to improve their IRR. But it's not impossible. That's how life is. But I'd say from a common sense point of view, I'd be surprised if Namibia jeopardized this development at this point, given the potential upside it provides for their economy.
Interesting indeed. Another question from the audience on PGMs. PGMs are levels or above levels, long-term averages. What is the legs on this sector? And is it changing or not?
I think it's evolving to a slight point. I think two potential drivers I see in the sector at the moment. I think there was a growing acknowledgement that it is a precious metal at a point this year. So I think once gold ran and silver was running, I think people acknowledged that if central banks were going to develop reserves of gold, there's a good chance they may be reserving or buying reserves of platinum as well. But I think the other more obvious factor for me is that while electric vehicles have taken off, I think a lot of people are sort of taking a stepping stone approach to that and going via hybrids first. And while you would think hybrids use less PGMs in the auto-catalysts, they actually use more than a traditional ICE engine, because the engine never gets warm enough for the catalytic reaction to take place. So I think with that drive in demand in hybrids, I think the fact that where PGM prices were, a lot of the recycling was uneconomical, so a lot of that fell away. So that may well come back online if palladium and platinum ramp up much higher. But I think it's going on the sort of coattails of gold for now to an extent, plus that sort of renewed interest in hybrid vehicles.
Barry, thank you. Just as a side question, you did allude to some exposure to Rand hedge stocks, and it was a question that came up a couple of times during roadshows as well. In terms of Rand hedges, I mean, with the Rand improving, what is the impact on Rand hedge stocks' performance?
They've been okay. I mean, they haven't really detracted from performance. I mean, the ones we bought at the start of the year, we bought Mondi, where we were of the view that the cycle was near the bottom in that industry, and with the resurgence in Europe, we thought they would benefit more. I guess it's sort of bumping along the bottom of that cycle for a little bit longer than we expected. So while the Rand has strengthened a bit, it's not really that's impacted Mondi per se. It's more that cycle hasn't picked up substantially yet. The other was Bidcorp, which has also, it's done okay. The results were also a little bit less exciting than expected, but it's not really detracting. It's kind of also just going sideways. So, I mean, half of our premise was right at the start of the year. We thought that some SA Inc. had gotten too expensive, so we did reduce some of our exposure to some of the retailers like a Mr. Price, and went into some of these, not in a big way, maybe 4 or 5% into these Rand hedges. They haven't cost us, but they certainly haven't provided any positive alpha at this point yet.
Another question from the audience, and I think it's the last question I'm going to take. I'm just conscious of time at the moment. It speaks to, I mean, we did cover this, and you also showed it, favorable terms of trade, really good tax collections. But the SA tax base, if that doesn't increase, SA may be stuck in a low growth spiral. So favorable terms of trade does not stay there. And we know our tax base is not expanding or increasing, the man on the street. How does that impact on SA growth, and specifically then SA Inc.?
Yeah, it's a tough one. I think you've got to, I guess, question how long this commodity cycle may last. I mean, the other one was sort of a bit of a flash in the pan in 2021. It started off and then it faded. But I would say if we are going into a world where there's going to be a lot of infrastructure investment, which we need for data center growth, for energy expansion, for replacing water infrastructure, not just in our country, but globally. A lot of developed markets do need to spend a lot of money on infrastructure. I think we could be entering into a longer sort of term growth phase for commodities, which will help us. I'd say if that wasn't the case, then yes, we do have problems. I think a lot of our tax base is or has been immigrating. I mean, I think it's turned out that maybe the grass isn't greener on the other side right now. I think a lot of people are questioning whether they would leave right now with what's going on globally. But it certainly is a risk, and one that we're conscious of, and one reason why we do always diversify our portfolio and do have some of those rand edges in there, because you can't be absolutely sure that things are going to develop one way. There's always those outside chances that happen more often than not. Sorry, one thing I just wanted to go back on was on the platinum. I think another reason for it is just the deteriorating relationship of the West with Russia, and the fact that they're the only other real main miner of metals, and the deterioration of their facilities because they don't have the capital, so their output is dwindling. So we really are in the pound seat, so to speak, with our sort of PGM resource base in South Africa. Sorry to sort of distract you. I just thought I'd add that.
100% fine. Very, very last question, just as a matter of interest. You did touch on, when we look at improvements in SA, is property valuations, and we've also seen it in SA property REITs. Significant improvement in valuations, and even if we, after that recovery, it's still very attractively priced. Do you at all look at SA property or REITs specifically that might find their way into the fund?
Yeah, absolutely. We've been a long-term holder, I think, since its listing in Spear, which has been a predominantly Western Cape focused property business. But I would say there's certainly merit in expanding that to someone with a more national footprint at the moment. We don't have it, but I'm not averse to it. I still see the opportunity for vacancies to reduce a lot in the commercial and office side as things improve in the economy. And other stocks that on our watch list are Sirius in Germany, also one we've owned in the past, mass around the corporate activity there. So I think there are definitely opportunistic players in that space at the moment.
Barry and Patrick, I am going to pause it there. It's been a very insightful discussion this morning, and your presentations as well on both of the funds. Barry, comment from one of our audience members as well, and it did show in your performance numbers. So despite the tough start to the year, if you look at your longer term numbers, you're still right above there or out there. So definitely that's what investors are looking for. And it's very low correlations or contrarian to funds that are more benchmark cognate, as you clearly illustrated. So if you are looking for something different, perhaps with a lot of value still to unlock in years to come, time will tell. Definitely a fund worth looking at in client portfolios. Patrick, the high yield fund as well. I think we covered all bases. Low volatility, outperforming cash, and very good with risk mitigation or managing risk for clients. So if you're looking for that steady eddy returns for clients, also a fund worth considering. Thank you both very much for your time this morning. I really appreciate it. And Eva, thank you for the quick update on Investec again. It is not 91. You are still the zebra. And with a huge investment team with extensive experience, more than 30 years, proven track record. So thank you so much. Dear audience, thank you so much for joining us this morning. And BCI team, thank you for setting all this up as usual. Quick reminder, next week, Wednesday, the 8th of October, we will see you again. We will continue with discussions on SA fixed income with Lorraine Capital. And we're also going to continue on unpacking views and opportunities on equity with Bataleur Capital. Gents, lady, thank you so much. To our audience, looking forward to seeing you again next week, Wednesday. Thank you so much.